a reader asked why inflation was higher in the 1970s than in the present time. Firstly, inflation is actually increasing quite a bit. We're getting close to 10% in the UK and the US, and that's not much higher than the 1970s peak for the US. But generally speaking, the world did have much higher inflation in the 1970s, especially in places like Japan and the UK and Europe. So I guess the first difference is that in the 1970s, the increase in the price of oil was more dramatic than it is now. In 1973, oil price tripled overnight, and this caused quite a shock because in those days we were more dependent on oil than we are now. Now obviously we're still very dependent on oil, but in the 1970s cars were quite fuel inefficient. We didn't have many alternatives to petrol, and when the prices went up, we had no alternative but to keep buying. So this increase in the price of oil in the 70s was larger, and also it had a more significant impact than it does today, because to some extent in the present time the high price of oil is encouraging people to switch to alternatives. We have electric cars, we have more fuel efficient cars, and so there is less impact of oil on inflation than we did in the 1970s. The second factor is the role of trade unions. In the 1970s, it was kind of a peak of trade union power and influence. In countries like the UK, the number of hours lost to strikes was very high. Unions had the capacity to bargain for higher wages. So when prices rose because of the higher oil prices, workers were quite adept at bargaining for inflation-busting wage increases. So as prices rose, wages rose faster, and this caused an accelerating effect on inflation, because when wages are increased in response to higher oil prices, this gives workers more money to spend, causing more demand pull inflation. And also firms see an increase in costs because they have to pay higher wages, so this encouraged the firms to put up prices even more. And one important thing about the 1970s is that from this spike in inflation in 73-74, inflation became entrenched, and it wasn't until the mid-1980s that inflation came under control. Whereas in the 2000s, there is some union influence, but it's much less. We have a more flexible labour market. A lot of workers are in the gig economy. And even in a country like the UK, which has quite severe labour shortages, there's no signs of real wages increasing out of control. And apart from a few specific industries, real wage growth is still quite patchy. And this means that inflation finds it harder to take hold. And if nominal wage growth continues to remain fairly subdued, then inflation is much more likely to fall back in the coming years. Another important difference with the 1970s is demographic trends. Why is this important? Well, in the post-war period, there was a lot of optimism, growing population, and growing working population. So firms were quite keen to invest in all kinds of new shops, business, and infrastructure, because the demand was growing, economic growth was very strong. But 30-40 years later, the age profile of many Western economies has changed quite significantly. We have an aging population. Working forces are starting to stagnate. There isn't the same growth. So ever since the financial crisis of 2008, firms have not been willing to invest all the savings. And the impact of this is we've had a period of ultra low interest rates. Ever since 2008, interest rates have been pretty close to zero. They've gone up a little bit in America, but very limited. And this reflects a low inflationary, low economic growth situation. So in the 1970s, there's much stronger demand, stronger investment, more confidence about the future of the economy. Whereas in the 2000s, we have this different climate of an aging population, and so underlying inflationary pressures are not the same as in the 1970s. a good example is Japan. Japan, from the mid-1980s, starts to see inflation become very low and often slip into deflation because they had an aging population, no immigration basically, and the miracle of the post-war Japanese economy kind of slowed down. And the Western economies like the UK and United States are kind of catching up with Japan now in terms of age profile and demographics. So this demographic influence is on its own likely to keep inflation fairly low, although it's been countered by the rising oil prices, at least temporarily. But if the oil price spikes stop, then we may see the demographic pressures on low inflation return. I'm saying this in the summer of 2022, and my prediction is that for the next couple of years, the inflation we see this year is likely to come down. The oil prices rises may continue for a bit, but they can't continue indefinitely. And if we take away these short-term factors of energy, oil, then underlying inflationary pressures are different to the 1970s. Now, if you're watching this in 2023 and inflation has reached 20%, then you can leave a comment in the video, but I don't know what I'm talking about. But I do feel that whilst it's always hard to predict inflation, I think we can see quite a few differences between the 1970s, the post-war period, and the 2020s, where although we have some inflationary pressures, there are also other factors that may hopefully bring inflation down, but of course create their own problems of low growth and higher poverty. So I hope you've enjoyed this video. If you have any questions about economics you'd like answering, please feel free to leave a comment in the question and I may make a video out of it. Okay, thank you.